You need to enable the participant screen share, that's all.
Yes. I've got to look at that.
That really rolled off the tongue. I've done too many of these Zoom calls now that the terminology is just so easy.
I'm going to surprise you next month, and I'm going to already have done that. So, but thank you.
Have you done it? I can't hear it.
There we go.
Good. Just while you're getting going, Sam, when would you like people to ask questions? Because would you prefer people to ask at the end, or just as you go through?
Yeah, I've got my final slide just as a teaser. Says any questions.
Oh, okay, okay.
Yeah, so maybe if we keep them to the end, just so, because do you know what? It's more for me, to be honest, because otherwise I lose my trail of thought and I can't remember what I'm talking about. So it's purely selfish reasons. But yeah, hi Chris, hi everyone. Yeah, really delighted to be back again. I love coming along to these meetings, and I'm really looking forward until we can do the physical ones again, and I can come along and have a beer with you all at the beach house, which would be fantastic. But just to kick things off, yeah, my name's Sam Norris. I'm one of the senior finance brokers at Bond Finance. If you are inclined, you can go and follow me on Instagram if you like, and there's a little pretty picture of what my Instagram looks like. Very, very technical. But let's kick things off. So this is what the kind of things I want to go through today. So first of all, a bit of an update. Obviously, it's been a month since we last spoke. So I'm just going to try and summarize what's happened in the last 4 weeks since we all got together. And then I'm going to talk a little bit about valuations, what we're seeing, what trends we're seeing, and a bit of news and updates on that. Then we're going to talk bounce back loans and the particular implications on buying property using bounce back loans, which are certainly of interest at the moment. And then our old friends, the mortgage payment holidays, or mortgage payment deferrals, as I like to call them. But just a little bit of an update on that very quickly, and then we'll finish with some questions, if that's okay, Chris. So what's new? So the main thing I think what's happened this month is apparently everything's now back to normal. So I think it was either the 12th or the 11th. I've asked a few people, and we're not quite sure which date it was, but let's say 12th of May. Government declares that the property market has officially reopened. All very, very exciting. What that meant in reality was that physical surveys could resume. Agents went back to work and they could conduct their viewings again. So the general public, it seems, just believed that overnight everything was going to return to what it was like pre-COVID. And we all know that wasn't necessarily going to happen. However, lots of positives came out of that. In my sort of part of the market, obviously in the lending industry, lender confidence definitely rose as a result of this. And we were certainly seeing a lot more lenders return to the market, both on the bridging, development and commercial side, as well as the kind of more mainstream and buy-to-let and specialist lending side. Not only were they returning, but they were returning with better products. LTVs were rising. And as I said, definitely some better products that we've been seeing throughout the lockdown period so far. There was still quite a lot of lenders that are at the sort of 60% loan to value range, but over the course of the last sort of 4 to 5 weeks, certainly, we've been seeing that many more are returning to that sort of 75% norm that a lot of us need when we're going, especially if we're refinancing some refurbishment properties or development properties. Really important for us to get to 75% because a lot of these deals are rely on that kind of lending on the back end. So as I said, many lenders returning 75. We've seen some of the specialist lenders like Foundation, Paragon, Kent Reliance, who are some of the big names in the more specialist part of the market, particularly on the sort of limited company ownership side. And two of probably the cheapest lenders on the personal ownership side, BM Solutions and the Mortgage Works, both returning again as well. If you can hear any noises in the background, my cat's decided to join us, so you might get a sneak peek of Harley the cat in a few moments' time. but we'll carry on. Some cracking rates as well at 75%. Birmingham Midshires, they're actually one of my favourite lenders, actually, Birmingham Midshires, because they do things quite quickly. And they've come back in with a 2-year fixed rate of 1.55%, which is fantastic. And the mortgage works with a 5-year fixed rate of 1.99. These are for sole ownership, not company ownership, remember. So very, very positive indeed. Just to get us even more excited, although I'll be honest with you, this is worrying the hell out of me. Hello, Harley. Can you go away, please? I'm very busy. Yeah, here she comes. This is fun, isn't it? Out the way, Harley. Come on. The Virgin have come back at 80% loan to value. This is for sole ownership, not company ownership. With a 2-year fixed rate at 2.99. Now, many of you might be looking at this and going, great, this is cracking, 80% loan to value mortgages. I think it's a bit dangerous, and I'll jump off my soapbox in a minute on this, but the reality is that a lot of people that are buying a limited company, I deem to be on the sort of more professional side. Virgin will lend to sole ownership, and sometimes these might include sort of accidental landlords and things like that that might not be as switched on to property as a lot of you guys out here, and so they might not know potentially the dip that we're probably likely to see, and they might find themselves in negative equity. All they're looking at here is potentially pound signs. I can put an 80% loan to value mortgage on my property, get some money out. They may not be looking a bit further down the line, where they may find it difficult to refinance in a couple of years' time. We'll see. I'm hoping that the market stays at no more than 75% until we get over, I think, what should be the inevitable dip, but we shall see. So let's talk bridging and development now. So bridging and development lenders, they're tending to be just a little bit more cautious, which is strange really, because these are usually the lenders that throw caution to the wind at given any opportunity, but they are being a little bit more cautious. One of the biggest players, Together, still not back in the market at all. I have daily conversations with Together, and a lot of their senior managers and underwriters, and at the moment there is no date for them to return, no plans whatsoever to return to the market. I've got a lot of cases in my pipeline with Together, and they are restricting, well, to the market as a whole, they're pretty much restricting all commercial cases. And when I say commercial cases, I'm including bridging in that, because it's a commercial type of finance, to 60% loan to value. Because of my relationship, I've been fortunate enough that they are offering 65% for most of my pipeline cases in order to get those through, and I'm expecting hopefully 5 or 6 to get it through this month, but it's tough, and it's taking up a lot of my day at the moment speaking to Together on those. Those that have re-entered the market, realistically, we're looking at a market-wide cap of around 75%. I'm actually being challenged quite a lot on this, with people saying, well, there's lots of people offering 75%, and I say to them, good luck with that. That's absolutely fine. There are lenders lending 75%, but they're being very, very particular. The risk factor on them is going to have to be minimal. If it's a buy, refurbish, refinance style deal, we are going to be looking at it, the figures being pretty phenomenal, the exit being very, very clear cut, and the experience level of the developer stroke investor being pretty good as well to get to that 75%. So if you are looking to buy and you're going to be needing a bridge, I would make sure that the figures work out at 70% gross rather than 75%, just to be on the safe side. Always good to have a bit of contingency anyway. In terms of development finance, what I'm saying is a bit of a sweeping generalization at the moment. Cap what you can get on a development finance loan in your calculations to 55% of loan to GDV, and if we can get more, great. But to be honest with you, if you can make it all work at 55, the cost of funds is going to be less, and the risk to you is significantly reduced. That 10% makes a big difference. So I would certainly recommend that anyway. So valuations, it's not been the overnight gates open, everyone rushing through that I think everyone was hoping for. It takes a bit of time. There's been quite a lot of sort of health and safety measures that have been brought in. Surveyors have had to get used to using those. We've had a bit of a backlog to get through, but they are going out. They are going out and they are being conducted safely. We're seeing lots of pictures of surveyors out and about with their masks on and their gloves and stuff. So it's good to see that they're keeping safe and following the guidelines. A lot of what we were originally getting from lenders in terms of feedback was that the delay was likely to be somewhere in the region of 7 to 10 working days. I wouldn't say we've necessarily seen it to that extent, but there's definitely delays, and they're very, very changeable from day to day. It very, very much depends on the workload of those surveyors, which of course can change on within a 24-hour period sometimes. So I would say to allow, especially if we're looking, I'm doing a lot of remortgaging at the moment. We're looking at remortgaging, just allow that little bit of extra time. So if you do have maybe a bridge coming to the end of its term soon, I would suggest starting that process sooner rather than later. One of the positives I've seen so far, and I'm kind of waiting for this to hit, is we haven't really seen the widespread down valuations just yet. I put down the valuations in brackets because in the little, I'll say brackets. That's it, quote marks. I just lost my train of thought then. Because in reality, I think a true down valuation rarely happens. It's a down valuation is maybe when the borrower is just expecting something a little bit higher, but the market doesn't necessarily back that up. But at the moment, everything's actually looking relatively positive. We are believing, we've not had this confirmed, because they don't necessarily want to be issuing this as a statement, but it looks as though surveyors are still using pre-COVID comparable data, because there just isn't really enough post-COVID data for them to be going on just yet. It is starting to creep through, but we haven't seen the dip yet, which is great. One thing that I have been suggesting is we don't know when this dip is going to happen. When it does, it will. I imagine it will hit, and I think it will drop to its nadir relatively swiftly. I think as everything kind of catches up, and we may sort of sit there for a little while before we start seeing the recovery. So if you are looking and thinking about refinancing, or you've got one due this year, it might be worth starting that process sooner rather than later, because as I said, we never know when this dip's going to happen, and it might be worth just getting that application and maybe getting that valuation at the very least done, so that we can get to offer stage, and even if there's a two-month period or whatever, once we get that offer to when we complete, we just hang in there and sync it all up. So I'd certainly be speaking to your lenders or your brokers to find out about starting that process sooner rather than later. So on the bridging and the sort of development side, certainly, I mean, even in normal times, what we generally see is that bridging lenders prefer to err on the side of caution when it comes to surveys and look at 180-day valuations. We are seeing that some lenders are pushing towards even 90-day valuations at the moment. Again, just erring on the side of caution a little bit. So we need to ensure that our exit looks good, and so that it means that even the 90 and 80-day vals are still going to match up with what potentially the open market valuation is likely to look like. As I said, not much change to the norm, but this sector is just showing a little bit of extra caution at the moment, which is fair enough. Had quite a lot of auction inquiries over the last few weeks, and I'm getting very, very split feedback from bridging lenders. There's a lot that are saying, no, we can't guarantee it. We can't guarantee the turnaround. A lot of that is going to be due to staff still being furloughed, and so they can't physically do the due diligence and the underwriting as quickly as they would normally. And of course, there's that delay with valuers. However, we've been working with a few lenders recently who have put some pretty slick operations in process. They've defurloughed quite a large proportion of their staff, and they are suggesting, that a 20 working day turnaround is still possible. What I'm stressing to my clients when we're looking at these sorts of cases, though, is that we're probably going to have to pay a little bit extra on the valuation to bump up our priority effectively. So because, you know, normally we'd say, okay, let's just go for it normally, and it might, instead of taking 3 weeks, 4 weeks to get the bridge done, you know, we have done them quicker than that, but on average 3 to 4 weeks, it might take 5 to 6. If we can bump up the priority and get those valuations done quicker, we can still stick to that 20 working day turnaround to complete on the auction purchases. So it's definitely still a viable option if that's your chosen method of purchasing properties. It's about SPAC loans, certainly something that's been in the news. So I think I've probably peed off quite a number of lenders over the last few weeks, asking the same question, you know, if I had a client that was using a bounce back loan as a deposit, how do you feel about that? The overriding theme of those conversations is, no, we would not, Sam, please do not put any clients like that our way. Mortgage lenders really are pushing back on anyone buying property using the bounce back loans. It's not what they were meant for, and the government guidelines stress this, which mortgage lenders are taking on board. Conversation I had with Adrian Maloney, of who's basically the sort of overall director of One Savings Bank that covers Precise and Kent Reliance, as well as Interbay on the commercial side. He was saying that they're pretty much issuing sort of lender-wide underwriting guidelines, that when they're looking at refinances, or when they will be looking at refinances in the future, that they need to be double checking the purchases and the source of the deposit, or the source of the cash to purchase the property if it was a cash purchase originally, because they are unlikely to refinance properties that have been bought cash using bounce back loans, and it might even stretch to those that have used bounce back loans as deposits as well, if you maybe been buying using a bridge or something like that. So this is something, again, just to be wary of. You might not be able to even get round it, even if you buy with cash and then look to refinance in the future. Again, the government advice has stressed that these loans aren't to be used for property purchases, and the mortgage lenders are typically across the board following this advice pretty much to the letter. I did have a conversation with Mint recently, though. Mint, who are what I deem to be a pretty sort of entry-level kind of bridger development finance lender, and they've suggested that firstly, if you were using a bounce back loan to do refurb work, that if you got a bridge with them, they'd be quite okay with that. They'd obviously want to do maybe some additional due diligence on the case, but as long as they could get comfortable, they'd be okay with that. But as long as the loans were taken by a professional property company, basically what that means is that the company that are actually taking out those bounce back loans, or the income that's been using to calculate the bounce back loans, is actually a propco, essentially. They did also suggest that they may look at taking bounce back loans as a deposit, but it's probably unlikely. So I would suggest that you just think of it as across the board bounce back loans when it comes to buying property. Probably not going to happen. Maybe get away with it when using it as your proof of funds for the works, potentially. So mortgage payment holidays, probably one of my most frustrating things to cover during the lockdown. We are definitely seeing lenders declining cases now where there are outstanding payment holiday payments. And what I mean by this is that, obviously, to give you sort of the quick, I suppose, 101 on mortgage payment holidays, interest is still accruing over the course of, say, a 2 to 3 month holiday payment, and therefore you do become you are behind on your payments or you're deemed to be behind on your payments by taking this holiday. If you are in that situation, lenders are deeming you to be behind on payments, and therefore they're not necessarily looking favourably on you. They're adding questions in to their application processes, asking, have you had one? Do you have one? Are you likely to take one? And they're taking the answers to this into account. Now, there's been an announcement this month that there's actually going to be a 3 months extension to the payment holidays, which for those that need it is really positive. For those that don't take them out, please, because we've actually had news as well this month. So the chief executive of Nationwide, Joe Granger, God, his name escapes me at the moment. It's definitely Joe something beginning with a G. Nationwide, the bank, so the lender behind the mortgage works on the buy-to-let side, has actually called that if anyone who either extends their payment holiday utilising the new 3-month extension, or now takes out a payment holiday, utilising these extra 3 months, that actually their credit files should be marked. Now, I was expecting potentially a couple of other lenders to jump on board on this, but it doesn't seem to be happening. But I think we just need to be wary that this is something that could potentially happen. And therefore, I am stressing that only take these holidays if you absolutely need them, because they can be detrimental to to your future prospects of applications. So just something to be a little bit wary of. Just sort of finishing off before I take some questions, just to remind you that my podcast, the Game Alone podcast, comes out every Monday and Thursday. I had the amazing Amy Rawlinson on this morning, so go and check that out. And I am also updating my YouTube channel, which you can find youtube.com, Sam Norris, the property investors broker. Very, very long word. And I put new videos up there Sunday and Wednesday discussing all things to do with the market and just keeping you updated. So now I'll kind of open up, as I think we've probably got just a few more minutes left to take any questions, Chris, if that's okay.
Yeah, that was super. I mean, wow, Sam, what a lot of information.
I know, I was trying to get it out as quick as I could.
You did super well. I mean, I've got a few questions, but I'll just open it up to the floor first and see if anybody else has got some questions first. If you want to unmute yourselves, you're able to unmute yourselves. I've sort of muted everybody because there's a bit of background noise.
Sam, I've got one. Hi, Sam. It's Andy.
Hi, Andy. How you doing?
Good, thanks. Yourself?
Yeah, fantastic. Thank you.
Good. Yeah, it was around that development finance 55% you talked about. So that would be on top of maybe some bridging or an existing buy-to-let investment, or is that all inclusive, or is that additional finance to what you've done from a purchase perspective?
So when I talk about development finance, what we tend to look at is an overall loan that will be split into two aspects, essentially. So there will be part of it that would be used to purchase the property. Generally, we say max that out at about 70% of the purchase price. And then anything remaining up to 55% of the gross development value can be used to contribute towards the works. Often, this does mean that it can cover sometimes 100% of the cost of the works. And this would be delivered in stage payments across the time it takes for the works to be done. So there would only be one lender in this instance. The only time where there might be another lender involved would be when maybe you had maybe some mezzanine finance and some junior debt, we would call that, just propping up what we call your stack, getting the loan to value on the purchase just slightly higher. But if we take it as a standard loan, development finance loan, it would just be one lender, a bit towards the purchase, and then a bit to cover sometimes up to 100% of the works. Does that answer your question?
Yeah, it does. Yeah, it's clear. Thank you.
Awesome.
Yeah, thanks for the question, Andy. Anybody else?
I think there's one from Julie in the questions.
Yeah, that's true. I'll be Julie. If someone is looking as a first-time buyer, sort of owner-occupier, what are their options at the moment? So I suppose, what would you recommend, Sam? What do you think would be the best routes?
Yeah, in terms of first-time buyer, I mean, I must admit, I don't do a lot of residential mortgages anymore because I focus my attention on the specialist side of the market. But we are seeing residential mortgages back up to 90% loan to value, would you believe? Accord, who are owned by the Yorkshire Building Society, they have released a 90% loan to value. Nationwide were at 85. I think there was talk of them going back to going up to 90 as well. Although I actually think they might have gone back to 80. But certainly there are options for 10-15% deposit as a first time buyer. these loans are regulated by the Financial Conduct Authority. So on the one hand, they do tend to err on the side of caution sometimes in terms of their due diligence and things like that and affordability calculations. But on the other side, they do push, they're sort of pushed to try and make these loans as available as possible because, of course, they want to promote home ownership and make it as easy as possible for first-time buyers to get onto the ladder. So they sometimes actually conflict with one another. So in terms of the criteria, pretty much the same as pre-COVID. Affordability calculators are the same, but we're just not seeing the 95% loans to values mortgages that we were seeing previously. I, for one, part of me again is kind of hoping that we don't see those back until after we've seen this dip, so maybe towards sort of February, March next year. But if I'm honest with you, it would not surprise me if one of these popped up even in the next couple of weeks, to be honest with you.
Okay. And what sort of rates? So at 90%, what sort of rates are you looking at, Sam?
Probably mid to late twos, I'd say. Maybe just 2.7, something like that.
Okay.
Yeah.
Okay.
As I said, my finger's not on the pulse of that part of the market as much as it could be.
No.
I've got my right hand man in the office to look after my residential mortgages for me.
I was going to say, I'm sure you know a man who knows. So
absolutely, always.
I've just got a quick question for you, Sam. I mean, I've got quite a few, but I'm going to restrict myself. You talked about paying extra for surveys to get them done quicker. Is this new if it's done before? And also, sort of how much more would you be paying? So it's an interesting development.
Yeah, I to be honest with you, I've been doing this my entire career. It sounds really underhand, but you have to remember that the bridging market is a much more flexible market. And do you know what it is? It's more a sort of a case of, if you're a surveyor and your bridging survey is £1,000, let's just make it nice and easy figures wise. You're doing a 9 to 5 day, and somebody says, do you know what? If I gave you 1,500 for it, would you do one at 6 p.m. tomorrow? You're going to go, yeah, okay. It's that sort of thing. So it sounds a bit cheeky. Do you know what it is? It's because the mortgage market is so rigid across the board in terms of criteria and process that you don't really see it there. In the bridging market, not so much in the development market because it's very specialist types of surveys, red book surveys that you're going to be getting for development finance. But on the bridging finance, it's been something I've dealt with for years and years. And I'm very open with my clients. I say to them, look, we'll go out, we'll get some quotes. The ones that are going to be able to do it sooner are going to be a little bit more expensive. So it's up to you. And if you are under time pressure, I'd say on average, it's maybe 20% more, which when you look at the overall picture, if it's the difference between you actually completing that purchase within the time frame that you need to, I think that's money well spent.
Yeah, I agree. Particularly, you covered the auction side. If it was on an auction on a really tight sort of deadline, you're gonna spend the extra 20%. So, it sounds like it's a little bit informal. This, so not sort of like
it's all relationship. Bridging is such a relationship-led part of the industry, and I'm fortunate. I've been doing this a while, and so you get to know these people a lot better. There are lots of bridging lenders out there that I have my own designated underwriter. So it's the same underwriter every single time. So I know how they work and we know what they want. And this is where actually brokers can differ from broker to broker, not necessarily in a negative way, but if you go to one broker, they might recommend one particular lender to you and another broker might recommend another one, similar sort of pricing, but it's all about that trust that particular broker has with that particular lender. And if you don't have the experience of actually seeing good quality service from one lender, even if the pricing is decent, you probably won't end up going to them because that trust isn't there. And I feel a bit skeptical sometimes recommending a lender that I haven't used very much or I've had a bad experience with just because the pricing's good, because with bridging, pricing is usually secondary to the flexibility and speed that we need in order to complete, and the trust that they're not going to pull the carpet from under our feet just before we complete, which a lot of bridging lenders have done in the past, unfortunately.
No, I agree. Well, that was packed. That was a packed talk, Sam. So really appreciate what you did.
I might go to bed now.
If you want to have a lie down, you can, even though Harvey stole your thunder, he had his 15 minutes of fame or 15 seconds of fame.
Yeah, I don't know where she's gone now. She's buggered off now, but there we go.
Right. That's great. So thank you again, Sam.